So let me start with you, Sachin. The Fund of Funds was born out of a deal between India and Japan. What are the views of Japanese investors on India? And what do you think are the odds of Japanese investors as a whole upping its interest in India's startup ecosystem in view of the anti-China sentiments in India?
Sure. So just quickly, I'll touch upon the Fund of Fund. So you rightly highlighted it's a Indo-Japan fund of fund where assets are primarily getting raised in Japan, and most of our LPs are in two buckets. One is large financial institutions who are purely financial investors, and the other bucket is large corporates from Japan. And the idea for these investors is to access the great innovation which is happening in Indian startups. Already increasingly you can see participation from Japanese investors in the early stage ecosystem. I think the Indian GPs and the founders, they appreciate and recognize, the Japanese, is a long-term patient capital. They believe in business building over the long term. And I think, the Flipkart event, the exit to Walmart was an inflection point because at around that same time, Nippon Life Japan, which is my parent company, took over the India franchise from Reliance Mutual Fund. And Nippon Life has had, a multi-billion-dollar alternate asset exposure. And they basically set this up, by getting in other investors from Japan. So yeah, we did the first close at $100 million, and happy to back Satish, India partners, and many more to go.
Okay, cool. Coming to you, Satish, you've started another year on a very high note, by marking the final close of your new fund this year. So, India Partners was raising this fund in the midst of the pandemic. Give us a sense of the fundraising climate and what were LP views on Indian startup ecosystem as of now?
Yeah, so whether it's, in terms of if you really look at the entire ecosystem, right? So you look at entrepreneurs and then you look at the GPs and then you look at LPs. Of course, my LP is here, on the session with me. It's no different, I think, for any of us. I mean, just the way an entrepreneur would have to run a sprint and a marathon, a GP would have to run a sprint and a marathon. And what LPs look for, I think, we're talking about 10-year fund cycles, right? Some of them may be 12, some of them may be 8 or 9, but at the end of the day, you're talking about 10-year cycles. So normally when LPs invest in VC funds, they're taking a mid to long-term view. No, we're not a private equity or, kind of debt asset class, and that to an early stage venture capital fund, we all know that 2, 3, 4 years you actively invest. Another 2, 3 years you work with your portfolio, grow them. And in the last 1 or 2 years, you look for exits. So from that perspective, I think the good LPs and the LPs, who are in it for long term, and normally they back, the GPs multiple times, which means that they know that they are in their journey for 15 to 20 years. So they're not perturbed. As an entrepreneur, I've been through the .com, meltdown while I was in Silicon Valley and I was running a company, a startup. We've all seen the financial crisis. And of course, last year it was surreal. The key is, how do you stay on the course and then, convince your investors, right, the LPs, that you've got an investment thesis, there's an opportunity, you've got a team, and you have the ability to kind of source and invest in these deals, grow them, and then create returns, right, at the end of the day. As long as you're able to strike that chord and that there is that trust and belief, I believe that whether it's entrepreneurs or GPs, both will get funded. While I might sound, it's easy to do, I believe that, if you stick with fundamentals, it's not that difficult to get it done.
Okay. So since you've just closed your fund, as a general partner, give us more insight into the ways and methods you executed to achieve alignment with your limited partners to not help just close your fund, but also lay the foundation for a long-term relationship that you talked about that is necessary for an LP and GP?
Yeah. So again, that's a very, very interesting, question, Joseph. Just like we always tell entrepreneurs, don't raise, bad capital for a good idea, and likewise good capital for a bad idea. The alignment between VC and entrepreneur is very important, and the alignment between the GP and LP is equally important or even more important. The key is, if you really look at what's your investment thesis, and do you have the team to execute your investment thesis, and can you build an institution when you're talking about a VC fund, and when you're talking about multiple funds. This is our second fund. Very important thing, we didn't change our investment thesis because of the pandemic. So the thesis remained the same. Our confidence level in terms of ability to execute, we were able to demonstrate in our Fund 1, and we have to demonstrate, in the rest of our journey, both the Fund 1, exits as well as Fund 2 investments and growth. And importantly, you look for an investor, and I'm not trying to put Sachin here on a pedestal. The very first call and the first meeting, I told Sachin that irrespective of whether we do business or not, I have tremendous amount of respect and love for his clarity and simplicity. I mean, he had so much clarity, the kinds of questions that he asked in terms of our approach, how are we going to source them, screen them, diligence them, add value, get upstream capital, look at the highs and lows that entrepreneurs would go through. And likewise, I had questions for Sachin in terms of how they could add value to our portfolio and to us as we build the institution. Just like entrepreneurs, even seasoned entrepreneurs require some outside-in perspective. Even seasoned GPs require great outside-in perspective from LPs, because we're all on the same side of the table. So it's very, very important to partner with folks who are there with you through this sprint and marathon, not just during good times, but more importantly during the bad times, and where you could definitely create that atmosphere of transparency, accountability, and trust. While you celebrate returns, it's very, very important that throughout this journey, you're able to foster that kind of relationship.
Okay, I would like to bring in Sachin and get an LP view on this. So you've invested into VC firms, so far. So what are some of the winning elements you are looking in an Indian VC? Because the pool of VCs in India has also increased, right? And how did you collaborate with your GPs in their fundraising process?
So we are a 12.5-year fund, right? And during this journey, of course, any GP we back, essentially, I am not deciding on that one fund. It's essentially the decision is 3x, right? If I were to commit 5 million, 10 million in one fund, as Satish rightly pointed out, it's a multi-year journey. It's a almost like 15 to 20-year relationship that you're building. So trust is very important. So when you're doing a $5 million commitment, you're essentially underwriting at least a $20 million, not to belittle by saying in terms of the amount of capital, but, just imagine a 15, 20-year time frame when you're investing into a fund. So we take a lot of time to build that comfort across. And as you rightly said, the pool of the GP has significantly increased now. Many of the GPs, they are leaving global platforms and they are starting out. We as a fund of fund, we are only focusing on domestic early stage local managers, which is seed to, Series B stage. There are very handful of them in the Series B. So largely it's seed to, A stage. And there, honestly, it's been driven by a lot of conviction in the last 10 years and not so much of evidence. The evidence is there in terms of, velocity, the follow-on funding that they've been able to attract. But, the environment like COVID really puts everything to test. How you have handled, your founders, do your founders call you? How are you on, where are you on the cap table? How other investors, are interacting with the founders and so on and so forth. So, essentially we look at, very similar things like what a GP would look at a founder. We also look at similar things in a GP, strategy, track record, repeatability of the strategy, the stability of the partnership. Are they in for the long run? Because over this 15 years, the GP is also going to put significant skin in the game. Right. There's a lot of, talk about high fees, but trust me, I get to see many of the GPs. I know many of their P&Ls as well. Only after a certain size and certain scale, you actually start, having a better life. So it's a very, very, difficult period that they, financially they go through. And essentially, so the alignment of interest is very important. The purpose of the GP is very important. And then because we are a fund of fund and, that there are not many who are focusing in the space in which we are, which is seed to B stage, fitment of the FOF, which in the opening remark, which I said, which is the Japanese angle. So a lot of our Japanese LPs are investing in our fund is to gain access to these underlying companies, access to underlying innovation which is happening. So we secure, certain rights, which when we invest in a particular GP. So we obviously look at their portfolio. We look at their, fitment or, how we could help them with the Japanese market access, right? So that is very important for us. And we have that very frank and transparent conversation with all the GPs that, look, these are the rights. This creates a alignment for us. Even I am a GP to my LPs. So we are very transparent in terms of, what are the obligations that I have undertaken so that the GPs are aware of what relationship they are getting into. And the other aspect is, the fundraising that you highlighted. So honestly, it's still very early days for us in the venture space. We are still unknown. We haven't done much as far as helping our underlying GPs with their own fundraising, but we are trying to at least help their underlying portfolio companies, because Japan is a bit difficult market. It's not as easily understood as, say, probably an Indo-US market, right? So it's a different market, and that's where a franchise like Nippon India would add a lot of familiarity. So those are the areas and those are the criteria, that we look at when we are evaluating a GP.
Okay. So Sachin, for you, was it a conscious decision to begin by investing in a, sector agnostic early stage VC firm and a specialist in a VC firm?
Honestly, my understanding of the market is there are very handful of, GPs who are sector focused, very handful of them. And as a fund of fund at the system level, I need to be aware of one of the risks, which is, overlaps, because I intend to build a portfolio of 12 to 15 venture funds, right? So there will be overlaps in the companies that will happen because that's the way the market is right now. So there are not many sector focused funds. I think it's a function of maturity of the ecosystem, the function of, the track record and the competency of the GP. Like in case of Satish and their partners, clearly they are early tech, enterprise, and health tech. That's their focus area. The other fund that we invested into is more into direct to consumer brands. We do look out for, niches, but honestly, it's a function of, at the portfolio construction level, how much of that capital can be deployed and whether that will, justify at the portfolio level, the kind of returns that we are expecting. So we do look out for them, but there are not many. Largely, it's a very generalist market at this point.
Okay. I'd like to talk about an exits now, and I'd like to bring in Satish, So while we have been seeing liquidity events for VCs in the past years, LPs continue to say that exits are too few and far between in India. What are your thoughts on it now versus what it was a few years back? And do you expect exit pace to pick up going forward?
Yeah, no, I'm very optimistic. I think in the next 5 to 7 years, at a very high level, macro level, my belief is that what we've accomplished as a startup ecosystem in the last 10 years I think we'll accomplish the same thing in the next 5 years. So probably coming from the engineering background, I could say Moore's law, will prevail, not just in, computing, but in venture capital in India. Very clearly, if you really look at earlier exits, IPOs were very, very few and far in between. And then majority of the exits were secondary transactions. But I believe now, you're going to see exits happening through multiple avenues. One of them, as you know, the international players and even large technology companies have very, very healthy balance sheets, and they have hundreds of billions of dollars, sitting on the balance sheet, and they want to deploy that capital, right, to be able to acquire. And we know that the entire Silicon Valley ecosystem is fueled by, the Facebooks, Googles, Apples, Amazons, Intels, Cisco's of the world, right? So you'll see a set of those folks acquiring companies. Certainly the decacorns and some of the fast, growing unicorns, global unicorns, would also start acquiring. I'm talking about these are companies from outside of India looking for, India and Southeast Asia kind of regional startups. That's the second, bucket. Now you look at our own country and, you look at the other two buckets. Very, very interesting to see now large Indian conglomerates, paying huge premium to buy. I mean, we've all been reading about acquisition of Big Basket or, Reliance Jio's acquisition of many startups. And then, same thing with Indian unicorns and Indian decacorns. I mean, we've seen, companies like Byju's and many others, who've been very aggressive, very quick in terms of acquiring and spending time on integration, digesting those acquisitions. So, and now we're talking about things like SPACs, things like direct listings. And I believe that it'll take some time, for India to realize the benefits of those. But even without those, and even some of the startups are talking about listing in India itself, right?
Right.
So with all of these avenues opening up, I think we're going to see a very fertile ground for exits. And I don't think we'd have a reason to complain in the next 3 to 5 years is what I feel.
Sachin, as a fund of funds, what is your assessment of the exit environment in India for VCs, and what are your returns expectations from your investments in India?
Sure. So first on the exits, see, it's a function of, and I agree with what Satish just said. Just because the media expects founders to go IPO doesn't mean that's the preferred route for one can generalize for all the founders. If you look at exit, the first question should come is exit for whom, right? For me as an LP, the exit means very different than for Satish and then for a founder. So, there are different what they take from an exit. Now, if you look at, it's a function of, the maturing ecosystem. Now, already a very, early employees, when the company reach like Series C, D stage, they're already seeing a lot of ESOP, monetization, which is happening by, the subsequent investors who are coming on the cap table. Number two, a lot of the companies which are, like a sideways growth, they're not able to go, they're not able to take that, up and to the right graph. There are acqui-hires which are already happening, right? I'm not repeating what Satish said, where conglomerates and, Indian houses, they've started acquiring. But at a fund level, recently I heard about Bloom, giving exits to its prior fund and continue to manage, the portfolio. I think there are secondary specialists at the fund level who are, if the asset is large enough, if there is a quality portfolio which is there, the secondary specialists are available. Number two, at least for, from my perspective, seed to B, what exit size, one is talking about. Not necessary every time you need a unicorn. Even at I have seen numbers, even at a $250 million last round, a fund would be on that company would be anywhere from 10 to 15x, one single company, right? So I think exits, we kind of, I've heard this lot of chatter and IPO, but exit for whom? And then, around that, I think there are exit solutions which are happening. Of course, IPO, dream IPO, it requires a lot of, it's a larger conversation, enabling regulation and all of that. Just to tell you, one data point, if you add up all the unicorns, I don't know, the number keep increasing every quarter, but if you add up whatever was the last reported, the total market cap of all the unicorns is about $125 billion. The market cap I saw on BSE is about $2.7 trillion, roughly about 4.5%. You go back and check on the US, what is the net negative income companies which are on the NASDAQ right now, what they constitute as a market cap. It's roughly about 2.5-3%. In 2.5-3% of the companies on US stock exchange are having negative net income right now. Compared to that NASDAQ, compared to that 2000 time, it was 6%. So still, markets can go wild, and I don't want to comment on that. 2.5% there, we are already at 4.5%. And these are the unicorns the media talk about, they will go IPO, 4.5% already. So it's also to do a lot of with regulation, and a lot of retail investors, a lot of increasing participation from HNI. They want to seek exposure, to these companies. So it's at different levels. It has to, it has to sync to make it enable, the IPOs.